the advantages, the same advantages as a C corporation. It has shares and stock. Now, I recommend if you set up a stock company that you get a lot of shares. It doesn't cost you any more to get 1,000 shares as 10 shares. But if you get it all, the ownership is dependent on the amount of shares that are issued. So if you get 1,000 shares, and 2 of you are going into business, and you get 50 and you get 50, you own 50%, you own 50%, but you have, 900 shares that haven't been issued. All of a sudden, an opportunity comes in to bring in a couple more people that you would like to, you have some shares that they can buy. So it could be an opportunity to raise money in the future. S corporation, I think, can have up to 100 shareholders. C corporation, pretty much unlimited. Limited liability company. It's a hybrid, a state charter. You're set up with the state of Florida. There can be a lot of benefits to it. Probably the biggest thing about limited liability is that attorneys feel that you have the most protection. Now, depending on how you do your tax structures, there may be some other tricks that you can do in here, like allocation of profits. So I may own 50%, you may own 50%, but I'm doing all the work, and we agreed for the first 2 years, I get all the profits. So I get 100% of the profits, and you get 0 for the first 2 years. Or you put in all the money, you get 100%, and I get 0 for the first 2 years. But that changes depending on how you choose to file your taxes. I recommend using, because of the opportunity you can do on payroll taxes, that you choose to file as an S corporation when you set up your LLC. So you set up an LLC with the state of Florida, but with the IRS, you elect to file as an S corporation. That means the profits are going to flow through and you're going to pay them that way. And then what you do is, and there's ways to do it correctly to avoid problems, but payroll taxes are 15.3%. If you're working somewhere, typically they're taking out of your paycheck 7.65%, and the employer is putting in 7.65%. So 15.3% is being paid on payroll taxes. Well, if I own a company, I certainly don't want to have payroll of $100,000 and pay 15.3%. When if I could hire a manager anywhere in town for $40,000 to do what I do, I'd pay myself $40,000 and take $60,000 as a distribution of profits because I own the company. So I avoid 15.3% of $60,000. How much is that? $9,000. It's a lot of money, right? So these are the kind of things, the reason you want to work with an accountant. I'm not an accountant. I don't work with the IRS. I don't get their updates on a daily basis. What I talk about is the experience that I've had in the past, but they made me change that yesterday. I wouldn't know that. Same with law. I can tell you different things that have happened that we've done and setting up things, but I'm not an attorney. Something maybe changed yesterday. I wouldn't know that. But that's all they do. They keep up with it. Basic financial concepts. I said this is one of the things that throws most companies. And guys, this is really a lot of fun once you get it. I know it might not seem like it, but you got to know, are you going to meet your expenses? I meet with a lot of clients, and they're in the hole $6,000 a month. And I go, well, how much you got left? I got $30,000 over there. I said, well, we got 5 months to figure this out, or you're out of business. How about that one we were talking about today?
Yeah.
Met with them at the beginning of last year, and I'm sitting there saying, hey, look, the way you're trending, when this money disappears, you're not going to be able to run this operation. Fortunately, you have some time to make it happen, and they're not doing it.
Yeah.
And it's going to hit them, and they're going to go out of business. But you've got to know, do you have enough money to make it to Atlanta? If you don't go. Are you going to be able to take a salary? Well, you should have that in your plan. You might not in the beginning, and a lot of people have some retirement, some other kind of thing that they're banking on, and they would rather, instead of taking money out, they'd rather use it in the company to grow the company. That's okay. Now, but it should be able to do it. I mean, after a while, you're going to get tired of, how many times do we see businesses that, Bill, how many times do we see businesses that they're not paying themselves a salary?
Right.
And they're tired of it. They're going, this is wearing me out, I'm not making any money. Well, you should have planned for that. When will revenues equal or exceed expenses? What is this called?
Break even.
Break even. That's what you're shooting for. That's when the business is paying for itself. You know, money's coming in, paying all the bills. Now I'm working on the future, I'm working on growing it, and I'm not sinking more money into it. That's where you want to be. You have to understand cost behavior, and most people in business don't get this. And when you get it, you're going to say, this is so simple, I can't believe they don't get it, but they really don't. There's variable cost and fixed cost. Variable costs vary with how much business you do. Fixed costs stay the same. So an example is, if I do deliveries and I have a truck and it uses fuel, my insurance and truck payment are fixed payments. If I have no deliveries this month, I'm going to have to pay that truck payment, I'm going to have to pay the insurance payment. But I won't have a fuel bill because I have no deliveries. If I have 1,000 deliveries, my fuel bill is going to go through the roof, you know, but my truck and insurance are going to stay the same. So we're going to talk about how do you get to break even and how do you control this. Break even. Okay, let's say this store has a 40% variable cost. 25% is inventory, and 15% they pay a commission. So they pay 40%. So if they sell something for $1, you know, 40 cents is going to go to cover electricity and the commission for that sale. Their fixed cost, rent, electricity, although you might think electricity varies, really in business is usually not that much. It's usually not the same thing every month. So let's say it's $1,000 a month, all right? Every dollar in sales, 40 cents cost of goods, 60 cents is left over to contribute to cover the fixed expenses. And you've heard that saying, we want to cover our costs, we want to cover our overhead. So 40%, I got 60 left to cover this. Now if I do this formula, then it comes out that I need to do $1,666.67 to break even, to pay my fixed costs and break even. You understand that? I'm going to back into it and show you how it works. I got $1,666.70, 25% is $416.67, 15% is $250, gives me a gross profit of $1,000. My fixed costs are $1,000, I break even. Okay? Right? Pretty simple. Right? Let's say the owner wants to make a whopping $1,200 a month salary. You know, that greedy person, you know. Now, how much in sales do they have to do? And you wouldn't believe how many people say, well, 1,667 plus 1,200, they need to do about $2,800 in sales. Right? Fixed cost now just went to $2,200. 22 divided $3,666.67. They had to increase $2,000 in sales to cover that $1,200. Now, if you get this, if you've got this concept in mind, it tells you, can you do something or not? So the person said, you know, I'm in a store and it's 1,000 square foot. And I do better in the store with 2,000 square foot. Should I move to the 2,000 square foot store? Well, using this formula, I would say, is that additional rent going to generate enough additional revenue to, after you do the formula, after you do the division with the contribution, to cover that rent? So if it doesn't, if I'm only going to do, my costs are going to go up $1,200, but my revenue is not going to increase, then you don't do it. So any of the expenses you do, should I put a picture on the wall? How much revenue are you going to gain from that? Should I add another employee? I don't know. Are they going to increase your revenue this much? Well, they'll free me up to do other things. Great. Are you going to increase the revenue this much? Because your cost of sales is going to be 40%. So you're going to, it varies by industry. Some 50, some 70. You have to know your industry. But you have to know this.